World Bank contradicts Tanzania's growth estimates. In Zimbabwe, risk perception trumps orthodoxy as inflation soars. Plus, JPMorgan hiring in Africa as more firms seek London listings. Hello and welcome. Thank you for joining us on Business Incorporated. I'm Chimezie Obi Iwawo. We get the show started with the markets, and most of the major markets we track in Africa were looking good at intraday, except here in Nigeria, where the main index was flat. The Jersey index in South Africa was up 0.48%, while the Egypt EGX30 was 0.26% positive at intraday. The Nairobi All Share Index finished positive with a 0.13% gain on Wednesday. And in the Middle East, Abu Dhabi stock surged 2.70% at about midday Nigerian time. Earlier, the stock saw their biggest intraday gain in nearly 4 months at 4%, led higher by the United Arab Emirates' largest lender, First Abu Dhabi Bank, which surged 6.5% on strong second quarter earnings. The Dubai index was also 1.73% in the green at intraday. On the other hand, Qatar's index inched down 1.04%, while Saudi Arabia's main index slipped 0.18%. In Europe, stocks traded lower in the morning as investors digested fresh corporate results and keep an eye on global developments. Well, Daniel Cook will give us more details. Hello, Daniel. Good afternoon.
Hi there, Jimmy. Good afternoon from Frankfurt.
Thank you. Well, let's start with the currency markets. The pound has been dropping because there is the fear once again about a possible hard Brexit scenario. What are you hearing there?
Yeah, exactly. Yeah, it has been dropping by between 10 and 15% during this morning, and that is quite significant, of course, and is monitored here by investors on the trading floor, but I'm sure also at the other exchanges in Europe. Well, there is this speculation again. I mean, we have to remember that Prime Minister Theresa May was not able to get this through the Houses of Parliament. Now she will be leaving the office very soon, and it is not very clear if her successor, whoever is going to be it, will be able to get this through Parliament at the end. Also, we were hearing again quite some strong rhetoric between the European Union and also between the United Kingdom, and as a result, yeah, now there is this fear that at the end we could see again a hard Brexit happening, and of course that is something what investors don't like at all, and also what the British population most likely at the end also doesn't want, because the consequences that the UK could face when you talk economic-wise, could be, that's what many have predicted, dramatically. So that's why we are seeing the pound dropping, and we'll be monitoring this very closely, how this is going to unfold.
All right, in corporate news, we're expecting news about the new CEO of BMW. Who's in the race?
Yeah, exactly. Oliver Zispe, that's what we are hearing, is most likely going to be the successor. We have to remember that the current CEO, Krüger, there has been quite some discussion in the last weeks or months if he would be the right one for the job. Then it was announced that he was not going to continue. He was always considered as a little bit too quiet, and investors did not really know in which direction he wanted to lead the company. Well, Zipse, he's very known already at BMW. He has been the one who was following the strategy not just to focus on production facilities here in Germany. He basically started this huge production facility and network around the world. BMW produced right now in the United States and China, also in South Africa. And even though the company is facing lots of problems also with the e-mobility sector, everybody always has been saying that if something goes right at BMW, then it's their production facilities. Also, Oliver Zipse is known to be able to make the right decisions, and also the right decisions if there are many people also in the company who are not agreeing with them. So he's known to be as a very strong person, and that's why investors are actually having some hope that he could be the right one for the job.
Okay, and still, of course, making the rounds, Berlin-based online bank N26 is now Germany's highest valued startup. It has raised about 490 million euros in additional funding. That's taken its valuation to 3.5 billion euros. Now, they have even bigger plans to expand. What are their plans?
Yeah, exactly. Yeah, their rise is quite fascinating, and many here in the financial world are taking a closer look already for quite some time there at N26. Well, they're following a completely different strategy when you compare this to local banks. They don't even have local banks. Everything can be done through your smartphone. I was looking on their website a little bit earlier. They promise when you want to open a bank account, it can be done within 8 minutes. And we are also hearing that there are more than 100,000 people in the United States currently listed in waiting lists who also would like to open an account at N26 once they start doing business in the United States. And also we are hearing that they want to enter the Brazilian market, which could be also very interesting for the lender. Certainly. Well, they also have to focus a little bit more on their customer support, because as I said, they don't have those local bank branches. Everything, when you have a question and you are not sure if everything goes right with your account, you have to contact them through a messaging app. And we are hearing from customers that this experience in the past sometimes was not satisfying them, because sometimes they were waiting for a couple of days or sometimes even longer to get an answer. And of course, with something that important, with money, you want a very fast reply. N26 now has promised that all of this is going to change and that they hired more people for their support department. I don't know really about you. I prefer that I can still talk to my local bank contact. I don't know. I mean, I'm very into technology, but I personally like still the personal contact when you talk to somebody at the bank.
I do agree with you. Honestly, I prefer the face-to-face contact, period. Anyway, thank you for your time, Daniel. And in the UK, the Office for Budget Responsibility says UK is likely to fall into recession next year if there is a no-deal Brexit. The OBR said economic growth could fall by 2% by the end of 2020 if it left the bloc without an agreement. Now, this would effectively forgo about 18 months of growth in Britain. In terms of data, UK retail sales figures for June is out. Well, let's bring in Juliana now to tell us all about it and more. Hello, Juliana. A very good afternoon to you.
Good afternoon to you too, Chime.
UK retail sales figures for June were released today. What are the numbers saying?
Well, it's surprisingly upbeat news from the retail sector today. Sales grew 1% in June, which is much better performance than analysts had expected. There were previous declines in May at 0.5% and in April at 0.3%. We've discussed this, Chimmy, at great length, that the British High Street is in decline. There have been big falls from, for example, the Arcadia Group, which is the umbrella company of Topshop and Dorothy Perkins. They haven't been doing so well at all. So it's not surprised that analysts had predicted a contraction. But nevertheless, there are some customers who have been going to second-hand shops and antique shops. Analysts say that they're the people that have been keeping the retail sales figures up. So this is very, very good news, because recently a lot of the figures we've been seeing coming from the UK with the PMI figures and with retail sales have been negative. So 0.1%, not a lot, but still positive.
Aside from the data, Asos shares slumped more than 15% in early trade today, as after the British online fashion retailer issued its third profit warning. That's in 8 months. What is going on with this fashion retailer?
Well, not great news for Asos, as seen on screen at all, Chimmy, and the shares have actually tumbled much more than that. They've tumbled to 27%, which means the company has lost more than a quarter of its value. The retailer issued its third profit warning in just 7 months to investors. This time they say that they've had issues with their new AI or automated warehouses. That's damaged sales both here in the UK and in the US, as they've been unable to keep up with the demand. I must say that there was a time when Asos was seen as the darling of the FTSE 100. Of course, we've seen there have been a number of falls in people going into shops to buy clothes. People are buying online, and Asos was really seen as the kind of contender of who you should be looking at to buy clothes from online. So anytime their sales fall, the market is worried because they're wondering where else consumers are spending their money. But it isn't all negative. They did report that their sales in the UK are up 16%, and also total sales are up 12%. So not bad, but definitely investors here in the UK are keeping a very, very close eye on them.
Let's see how the markets are doing generally. It's past intraday trading at the equities and, of course, the currency markets. How are the markets faring?
Well, even with those positive retail numbers, the FTSE is still in the red. Investors are nervous that Trump could reignite the tariff war with China. At intraday, the all-share is down 0.34%. The FTSE 100 slides 33 points down to 0.30%, and the FTSE 250 is down 0.33%. Those retail sale numbers have helped sterling. However, surprisingly, the British pound is up today on the US dollar by 0.37%, up on the euro by 0.47%, and up on the Japanese yen by 0.31%. I must say investors are saying it's a quick rebound, so sterling may fall tomorrow.
Well, let's continue to keep a tab on those markets. Thank you, and enjoy the rest of the day, Juliana.
Thank you, Chimi.
And in Asia, stocks in Japan were the biggest losers among major markets in the region, with the other Asian bourses following suit amid a renewed threat to trade. The Nikkei 225 dropped 1.97%. The Topix also fell 2.11%. Elsewhere, shares in mainland China also saw losses on the day. The Shanghai Composite declined in 1.04%. The Shenzhen Composite also fell 1.633%. Hong Kong's Hang Seng Index declined 0.66%. South Korea's Kospi declined 0.31%. In Australia, the ASX 200 shared 0.36%. And in the U.S., stock index futures were slightly lower in the morning as earnings season gathers momentum. At around 4:30 a.m. Eastern Time, Dow futures were down 93 points and indicated an implied negative open of more than 70 points, while the S&P 500 and Nasdaq also pointed to lower opens. As earnings season kicks into full gear, railroad giant CSX posted weaker than forecast quarterly results on Wednesday, sending its stock plummeting, while Bank of America reported better than expected earnings but warned that lower rates would hit its net interest income growth. Both United Airlines and Cintas also beat expectations, indicating that the bleak outlook offered at the beginning of earnings season might have been overly pessimistic. However, only around 7% of S&P 500 companies have reported second quarter earnings thus so far. Now, another flurry of earnings is due today. The Morgan Stanley, Union Pacific, SunTrust, and M&T Bank reporting before the bell, while Microsoft is set to report after the bell. And away from the equities market, back here on the African continent, JPMorgan Chase & Co. is hiring in sub-Saharan Africa as the New York-based bank works with companies to list their shares in London despite Brexit uncertainty. More offerings are expected over the next 12 months as African businesses seek to tap deeper pools of capital. The increased interest comes amid a $3.5 billion share sale by Airtel Africa Limited, London's third largest IPO this year, and follows a roadshow by officials from the London Stock Exchange earlier this year to spur more issuance. Interest is starting to spill over into South Africa, where deal flow has been hindered by a contracting economy. We'll take a break now. When we come back, we'll look at the commodities market space, of course, all the stories. Just stay with us.